Welcome to Illuminati Silver. We tell you the truth about silver. Today is Monday, the 27th of August 2018, and we're briefly covering the gold to silver ratio and why it is important. Anyone who has watched a YouTube channel or read an article in the gold and silver space will undoubtedly have come across the issue of the gold to silver ratio. Well, we shall address what it is and why to some it's important and to others less so. First, a simple definition. Basically, the gold to silver ratio is the amount of silver it takes to purchase 1 ounce of gold. I'll say it again. The gold to silver ratio is the amount of silver it takes to purchase 1 ounce of gold. With gold currently standing at $1,205 and silver at $14.82, we divide the silver price into the gold price and come up with a ratio of 81.3 to 1. Yes, gold is 81.3 times more expensive than silver, or you need 81.3 ounces of silver to be worth the same value as 1 ounce of gold. So why is it important? And to whom is it important? Well, investors who trade gold bullion, silver bullion, and other precious metals scrutinize the gold to silver ratio as a signal for the right time to buy or sell a particular metal, and in some cases to sell one and use the proceeds to purchase the other. So when the gold to silver ratio is high, purchasing silver is preferred, and when it is low, then selling silver and or purchasing gold is preferred. However, there is a dilemma with this strategy. Because the gold to silver ratio fluctuates so widely, it can be difficult for inexperienced, new or small-scale investors to read the signals and make a profit. So generally, because of the costs involved, much of this selling, buying and swapping strategies tend to be more confined to the paper markets as opposed to the physical. Although having said that, we are aware of physical holders doing this. But they have to factor in the costs and assess whether the transactions are large enough to cover these costs and to make it worthwhile. So what is a high ratio and what is a low ratio? Well, let's look at this in an historic context. Some records date back to the late 1600s, where the ratio vacillated between 14 and 100. Come the 1900s, however, the ratio remained quite steady at or around 16 to 1. This was likely because many countries were using gold and silver-backed currencies. For instance, France and the United States assigned statutory limits on what the ratio could be. In addition, the US Geological Survey estimated that there is just over 17 times more silver in the Earth's crust than gold, which could provide another explanation for the pre-1900 gold to silver ratio average. However, throughout the 20th century and into the 21st century, the gold to silver ratio has averaged somewhere between 47 to 50 to 1. Now please note that we say averaged. For example, on the 1st of January 1970, when quite precise records were established and made publicly available, the ratio was just over 18 to 1. On the 1st of January 1991, it peaked at just above 102 to 1. And since then, it's been as low as 38 to 1 on the 1st of April 2011. But as we say currently, it stands at 81 to 1. What we have noticed, and this isn't a revolutionary discovery, but currently most investors, certainly in recent years, are of the opinion that whenever the ratio hits or rises above 80 to 1, that is the time to sell gold and buy silver. And from a trading aspect, that has tended to pay dividends quite handsomely. However, there is something we must point out. And please do not be fooled by the logic. Well, if it comes out of the ground at 17 to 1, then the price should eventually revert to that ratio. Absolutely poppycock. For example, a typical apple costs 40 cents, an orange 60 cents, and a grapefruit 80 cents. But they don't come out of the ground or grown in those proportions. There is also far less platinum in the world than gold, and yet platinum is cheaper. So let's eradicate that thinking. We may be more favorable to that idea if gold and silver were perfect substitutes for one another, and so one would automatically swap one for the other. But that is not the case. So in theory, there is nothing to stop the gold to silver ratio becoming 110 to 1 or 30 to 1. It all depends on both the speculative and real demand for one compared to the other. What is fair to say, though, is that people who follow charts are in themselves pretty predictable. And so when this magical 80 figure is breached, market corrections do occur. But having said that, as any genuine investment advisor will tell you, the past may not be an accurate indicator of the future. But for those who truly believe this stuff devoutly, then we shall feed you a little silver porn, pardon the expression. And here it is. In the end, in order for the ratio to return to its pre-1900 average at the current gold price, the price of silver would need to rise to approximately $75 per ounce. Likewise, if the ratio were to drop to its long-term average, silver prices would rise to about $25 an ounce. And it is this porn that the porn filmmakers, or in other words the pumpers, will feed you until you pick up that phone and purchase more silver. Now this subject is much more complicated than this, and there are various trading algorithms and patterns which do indicate what one should do or not based on historical data. However, they're not always accurate, for if they were, then the majority of people who trade would make money, where it is estimated by professionals that less than 10% of traders make money on a consistent basis. We shall be discussing this in greater depth within our inner sanctum in November. Meanwhile, and broadly speaking, if you believe that historical data is important and does reflect at least the psychology of traders, then in relative terms at 81 to 1, silver looks like a better investment opportunity than gold. We thought you would like to know. We hope you have found this video interesting and informative, and if so, please give it a thumbs up and share it on Twitter. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe as a free member for regular email updates and offers. Disclaimer: Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.